through a relatively short reading, sampling and estimation from the quant section of Level 1 curriculum. So first, I think we need a little bit of terminology here. So let's go through these bullet points. To make inferences about the parameters of a population, we'll use a sample. Think about having a big barrel of balls all with numbers on them, right? And we want to know, what's the mean? What's the average value in this barrel of balls? Well, one way to make probabilistic statements about that is to take out 10 balls, add up the numbers, divide by 10, and use that as our estimate of the mean. So if we're taking a simple random sample, everyone has an equal chance. So if we move these balls around enough so that when we grab 10, any ball would have the same chance of being selected, then that's a simple random sample. Now, a sampling distribution is the distribution of sample statistics for a repeated sampling for samples of size n. So we have a given sample. Well, I talked about taking 10 balls out, taking the sample mean, that's our sample statistic, and the sampling distribution would be the distribution of outcomes, of sample means, if we did that 100 times. So our sampling distribution, we draw a simple random sample of 10 balls 100 times, and we plot that mean value for those 10 balls. Well, the distribution of those is the sampling distribution. Now, sampling error is the difference between a sample statistic and the true population parameter. So if we know the mean value on all those balls in the barrel is 5, and we take a sample of 10 and calculate the sample mean, and it's 6, our sampling error is 1. We're 1 off from the true mean of the population. So that's our sampling error. So our sampling distribution shows us all our sampling errors, right? The differences between each sample statistic, our sample mean for the 10 balls, and the true mean of the population. Now, often you don't know the true mean of the population, but we can still get a grip on this concept of sampling error. Now, what is stratified random sampling? We said in simple random sampling, every outcome has an equally likely chance of being chosen. Well, stratified random sampling, and it helps to know how we use this in finance. We use this sometimes to match a bond index. Bond index has a lot of different bonds in it, and some of them don't trade very often. The pricing is stale, they're not liquid. So when they go to put up a bond index or a fund that's going to track a bond index, they want to match the characters of the index itself, but with a smaller sample. And that's when we use stratified random sampling. So how does this work? Well, first we're going to create subgroups based on important characteristics. So here we've got some listed: callability, ratings, maturity, coupon. We could have puttable bonds, you know, some AAA bonds, some AA bonds. And so now imagine we're going to get boxes. And each box is going to say callable, A-rated, short maturity, par coupon. And we take all the bonds that fit those characteristics and we put them in that box. And then we have another box that's the same as that one, except it's for non-callable bonds. And then we have more boxes with the same characteristics except different ratings. And so we select these subgroups. So now we've taken all the bonds in the index and we put them in all these different boxes. And then we take a random sample from each box. So we end up, if there's 50 in the box, maybe we're choosing 15. Now, what do we get out of this? Well, what we get out of this is when we put our portfolio together of our randomly selected bonds from each subgroup, our portfolio we put together is going to match the index in these important characteristics. That it will have the same weight in callable bonds, the same weight in triple A's versus triple B's, the same mix of long, medium-term, and short-term maturities, the same mix of coupon bonds and zero coupon bonds. Because if we did just simple random sampling, we might, just by chance, choose an awful lot of callable bonds or an awful lot of long maturity bonds. And then our portfolio wouldn't match the index in those characteristics, and we might have some risk there that is different from the risk of the actual bond index. So that's the idea of stratified random sampling. Here's some pretty easy definitions. Time series data versus cross-sectional data. When we're talking about time series, we're just talking about data across time. Simple as that. In our example here, monthly prices for IBM stock for 5 years, that's time series data. Cross-sectional data is at a point in time or over a range of time. Our example here, returns on healthcare stocks last month, that's cross-sectional data. And sometimes we pool these data. We could have, if we had monthly prices for the last 5 years for IBM and all other similar technology stocks, then we'd have both time series and cross-sectional data. Now here's the central limit theorem. This is important to us when we get to hypothesis testing especially, but also as we do some confidence interval stuff. So let's read it first. For any population with mean mu, so that's the true mean of the distribution, and variance sigma squared, the true variance, as the size of the random sample gets larger, the distribution of sample means approaches a normal distribution with a mean that's equal to the true mean of the population and a variance that is equal to the variance of the population over the sample size. So the variance is getting smaller as the sample size gets larger, and the variance is around the true mean. Excuse me. And why do we like this? We like it because it allows us to make inferences about and construct confidence intervals for population means based on sample means. So let's go back to the barrel. Go back to the barrel with all the numbers in it. Remember, we were going to try and get a grip on the true mean of the population by drawing these samples of size 10. And we had a distribution, we had our sampling distribution of sample means, sample statistics, around the true mean. What the central limit theorem tells us is as this 10, my sample size, gets larger and larger, this distribution of sample means around the true means is going to start to look like a normal distribution. And also, the mean of my sampling distribution is going to get really close to the true mean. So that's why we use this central limit theorem, because then I can use the characteristics of the normal distribution to put confidence interval on the true mean. So what about the standard error of the sample mean? Well, it's really just the standard deviation of the sample mean around the true mean. And what we've got on the slide here, standard error of the sample mean is the standard deviation of the distribution of sample means. Well, we said the variance of this distribution of sample means was sigma squared over n. So what's the standard deviation is the square root of that. So what's the square root of that? Well, it's right here. And that's how we end up with the square root of n in the denominator. And that just tells us, remember, this standard deviation tells us how spread out these sample means are around the true mean. And this just says as n gets larger, that standard deviation gets smaller. Smaller how fast? Divide by the square root of n. So if I take one ball out of the barrel, I could use that to estimate the mean. It is an unbiased estimator. That is, I don't know if it's too low or too high, but maybe not a very accurate estimator. It may have high variance around the true mean. But if I take out 2 balls or 10 balls and take the mean of those, I'm going to get a better estimate. A better estimate in the sense that my estimates are going to be closer to the true mean. This distribution of sample means standard deviation getting smaller, we're more clustered, more close to the true mean. Now, when the population standard deviation is unknown, we're going to use the sample standard deviation, but it's the same thing. We're still going to get a better and better estimate of the true mean with higher sample sizes, and the standard deviation of those sample means around the true mean is going to be lower. So let's take a look at an example here. It says the mean price-earnings ratio for a sample of 41 firms is 19, and the standard deviation of the population is 6.6. What is the standard error of the sample mean? Well, given our sample size of 41, the standard deviation of the sample mean around the true mean, which is what we're calling our standard error here, is simply standard deviation of one individual observation, the population standard deviation, divided by the square root of n. So if we just took one firm as our sample, our standard deviation around the true mean would be 6.6. If we take 41 firms and take the average price-earnings ratio for those 41 firms, the standard deviation around the true mean price-earnings ratio is going to be reduced to 1.03. And the formal interpretation for samples of size 41, the distribution of sample means would have a mean of 19 and a standard deviation of 1.03. And we might say that it has an expected mean of 19 because we know for any given sample we don't have to be right on 19 as the mean. It's going to be somewhere in this distribution of sample means around the true mean. So the larger the sample, the better the estimate we're getting. Now, what are the desirable properties of an estimator? Well, I said if we take one ball out of the barrel, we've got a pretty good estimator. It's unbiased. The expected value is equal to the parameter. If you had to guess ahead of time and you knew the average value in there, you knew the mean of the population of balls in the barrel, what's your best guess of what value you're going to pull out of there with one ball? Well, your mean would be your lowest variance estimator. Now, the next characteristic that's desirable in an estimator is efficiency. And this means the sampling distribution has the smallest variance of all unbiased estimators. So if we pick between two estimators and they're both unbiased, but one has a higher variance, the one with the less variance is a better estimator. So we say an estimator is efficient when of all the unbiased estimators, it has the least variance. And our third characteristic or property of an estimator that we want to see is consistency. And consistency means the larger the sample, the better the estimator. Well, grab a sample of balls and take the mean as an estimator of the true mean of the population of balls in the barrel. It is consistent because we said as n gets larger, the standard error decreases with larger sample size. So this idea of taking the mean of a sample of balls as our estimator of the true mean. I know it sounds simple, but it's best to start with a simple case. It is unbiased, it is efficient, and it is consistent. Okay, next up for us here is to talk about a point estimate and a confidence interval. So remember, we got this sample of 41 firms. The mean is 19. So where do we come up with that? Well, we take a sample of 41 firms and we take the mean price earnings mean price earnings ratio, and that's our estimate of the mean price earnings ratio. And that's 19. That's our point estimate. But we need to use the standard error because we don't know if that's the true one or not. That's our sample estimate. So we need to look at the standard error of the sample mean in order to make some probabilistic statement about where the true mean lies. So let's take a look at it in this context. We've got our point estimate plus or minus 165 times 103. Well, that 103 was the standard error of our estimator around the true mean. And 165, that's our reliability factor for a 90% confidence interval, right? Plus or minus 1.65 standard errors on either side of 19. That's our 90% confidence interval. The idea is there's 5% in each tail, right? And we're only going to get observations outside of there 10% of the time. 5% in one tail, 5% in the other tail. So we're saying this 90% confidence interval plus or minus 1.65 standard errors around our point estimate of 19. For a 95% confidence interval, what's going to change? Just this reliability factor. Because now we want to get an interval that puts 2.5% in each tail and 95% within the interval. And so that's our reliability factor of 1.96. So if we want to be 95% sure that the true mean is in that interval, compared to a 90% confidence factor, we need to make it a little wider, and that's what you'll see in our last note here, 17 to 21, a little wider than 17.3 to 20.7. And our 95% confidence interval for a chosen firm is right here. So if we took one firm at random and we said, well, what's the interval that 95% of the time the PE will be between those two values? Well, now it's 6.6 because that's the standard deviation of a single observation. So now we're not dealing with the standard error of the sample mean. We're dealing with the standard deviation of a single observation. In this case, a single firm chosen at random. So if we're going to choose one firm, we say, well, 95% of the time, its PE is going to be between 17 and between 6.06 and 3194. So our confidence interval gets wider at 95% than 90%, but it gets narrower as we talk about the confidence interval for the mean of a sample than for a single observation. Now, we've talked about normality, and we used the central limit theorem to say, well, you know, if I'm grabbing sample means of a decent size out of this barrel, I can assume they're normally distributed. Well, sometimes we can't assume that, and an alternative distribution to the normal distribution is the student's t-distribution. And it's symmetrical. In general, it has fatter tails, meaning more probability further from the mean, greater probability of extreme observations or outliers. And the shape of this is defined by a single parameter, which we call its degrees of freedom. And degrees of freedom for our purposes here is simply n minus 1, one less than the sample size. Now, as those degrees of freedom increase, which is the same thing as saying as the sample size increases, the t-distribution approaches the normal distribution. So say with degrees of freedom of 30, our t-distribution has fatter tails than a normal distribution. But by the time we get up to n equals 150, 200, it's about indistinguishable from a normal distribution. So, lower sample size, fatter tails. And we'll take a look at when we have to use the t-distribution versus the normal distribution. So here's a little picture of what I was talking about. Here we have with degrees of freedom equal to 1, there's the distribution around the mean. In this case, we have a mean of 0. And here's degrees of freedom for a larger sample size. What sample size? Well, sample size 101, because we know degrees of freedom is n minus 1. So it's not so important the center here. What's important is the tails. So let's say I were looking at this student t-distribution with degrees of freedom equal to 100. And I drew a confidence interval. And I said, you know, and I'm just drawing these kind of randomly here, so ignore the numbers. But let's say I wanted to put 90% confidence interval. And I've got degrees of freedom equal to 100. So I've got 90% of the distribution between here and here. But now, and so what does that leave? If that's 90%, I've got 5% in this tail and 5% in this tail over here. Well, now let's look at degrees of freedom equal to 1. So I've got a smaller sample size. What happens to my confidence interval? Well, I need 5% in this tail out here, and these tails are fatter with degrees of freedom equal 1. So now I've got more than 5% in the tails. So for degrees of freedom equal to 1, what happens to my confidence interval? It gets larger. I've got to take a larger interval to make sure I've got 95% of the observations in that interval. When the tails are fatter, it's got to be wider. Because remember, we just want 5% in each tail. So fatter tails, we got to move out further to get down to 5% in each tail. So, more on constructing confidence interval here. For our normal random variable, we take the mean plus or minus some reliability factor, depending on our amount of confidence or significance, times the standard deviation. So for a normal distribution with mean equals to 3 and standard deviation at 2, if we want a 90% confidence interval, we put in our reliability factor for a normal distribution plus or minus 1.65 standard deviations, plug in our standard deviation of 2, and we get a range around the mean of 3 of minus 0.3 to plus 6.3. So we'd say, well, for this normal distribution, we're 95% sure if we grab one at random, it'll be between minus 0.3 and 6.3. If we want to be more confident that it's going to be in our interval, we need to widen our interval. And our reliability factor for a normal distribution, for a 95% interval, 1.96 standard deviations either side of the mean. Now, when do we use the t-test, and when do we have to use the z-statistic, which, remember, is for our standard normal? Well, we've divided it up by whether the distribution of the balls in the barrel, the underlying distribution, is normal, or whether it's not normal, non-normal, or we don't know what it is. We can't say that it's normal. And then we're going to also divide these by whether or not the variance is known. Now, if we have a non-normal distribution and a small sample size, we can't say anything about anything. So that's the first thing I want you to get from this slide. If you don't know the distribution of the balls in the barrel and you've got a small sample size, 30 or less, you can't make any inferences about probabilistic statements about the mean of the balls in the barrel. Now, the other one we have to look at specifically is right here. The idea is if we know the variance, we can be more accurate. If we don't know the variance, what are we going to use instead? Well, we're going to estimate the variance from our sample. And if we're estimating it from our sample, we're not getting the true variance. We're getting some value within a range around the true variance. That's really why we're using the t-statistic, is because we're unsure of the variance. And if we're unsure of the variance, we need a little wider interval to make sure we've got 95% of the outcomes in it. So if you have a small sample size and variance is unknown, we need to use the t-statistic for sure. Now, we can use the z-statistic when it's normal or when it's non-normal, as long as we have a large sample size. So here's our z-statistic, z-statistic, z-statistic. We can use that with a large sample size if the variance is known, whether it's normal or non-normal. So, why do we have to use the t-statistic in these others, or why is the t-statistic the better statistic to use? Well, let me clear this up and go back to that point and say, look, if the variance is unknown, you need to use a t-statistic with a small sample size, as we said, and you should really use the t-statistic with a large sample size. Now, the reading tells us it's permissible to use the z-statistic here, but it's not exactly accurate, and why would you? You know your sample size. You can subtract 1 from that and get your degrees of freedom. You can look at the t-tables. So while the z-statistic is acceptable here, the t-statistic is more precise and would be better. So let's sum up again. Non-normal distribution, small sample size, don't know anything. Can't make any statements about a confidence interval. If we have a large sample size, we can pretty much use the z-statistic all the way down, but it's better to use the t-statistic whenever the variance is unknown and we're estimating it from our sample. Now, some of you are wondering, well, when are we going to know the true variance? Well, not too darn often, as it turns out. We hardly ever know the truth. We're always looking at samples and estimates. So this is very common in the statistical tests that we'll run into. And lastly, you can use the z statistic for a normal distribution and a small sample size if your variance is known. So try and get that straight as to when you use the t. You use the t when you can't go wrong when the variance is unknown using a t distribution, except for non-normal population, unknown variance, or known variance. You can't make any statements about that. Okay, let's work through an example here. We've got a normal distribution and unknown variance. Normal distribution, unknown variance. Well, I'm thinking, what did that slide just tell us? It said normal distribution, unknown variance. The sample size is small, 30 or less. We need to use the t statistic. And if the sample size is large, it's probably best to use the t statistic. So it's back to our earlier example. We've got a sample mean of 19, a sample standard deviation of 6.6, and our sample size is 41. Establish a 90% confidence interval for the population mean. Well, we're going to say our confidence interval is 19 plus or minus these standard errors on each side. How many standard errors? Depends on the sample size and our assumptions about the distribution of the sample means. So our t reliability factor here is 1.684 for degrees of freedom equals 40, and a over 2 is 5%. That says 5% in each tail. So that's putting 90% in our confidence interval. And notice, what was our reliability factor for the normal? 1.65, or I guess more precisely 1.645, something like that. Notice that with the t distribution assumption, we need a little wider interval. That's why that reliability factor of 1.684 is a little bigger than the reliability factor if we had or could assume that these sample means were normally distributed. So now we calculate our standard error, same as before. We take the standard deviation of the population values, divided by the square root of n, get 1.03. Now we use our reliability factor from the t-table based on 40 degrees of freedom and get a confidence interval here. So what is our probabilistic statement? Our probabilistic statement is we're basically 90% confident that the true mean of the distribution is within this range, 17.27 to 20.73. Sample size issues. So far, everything we've done, it sounds like bigger sample size is always better. Well, there are some mitigating factors and some trade-offs here. One, cost can be a factor. Obtaining more data can be more costly, so there's a trade-off between what? Higher cost and accuracy. At some point, the higher cost is not justified by the increase in accuracy. The other sample size issue to consider is that including more data points from a population with different parameters won't improve your estimate. Let's say we're estimating the relationship between the money supply and interest rates. And we get some sort of money supply changes and interest rate changes. So we get some data. We've got some data from 1946 through the present. And we think that this relationship has stayed stable over that period. Well, so we can use that data. We can use that data to estimate the relationship. But there's more data available. We've also got data from 1946 going clear back to 1925. Are we necessarily going to get a better estimate by including that prior data, by increasing our sample size of more data? Well, maybe and maybe not. If the relationship was stable and exactly the same over the whole period from 1925 to the present, yes, we'd get a more accurate estimate by adding this data from earlier years. But what if there was an underlying change in the economic relationships and that post-World War II data, really we think the relationship is different than it was between 1925 and 1945. Well, if that's the case, you're not going to improve your estimate by adding that pre-war data. Because that pre-war data, what you're trying to estimate, was actually different over that period. So those are the two issues you need to be familiar with about sample size. Yes, more data is better, but one, the increase in accuracy may not justify the additional cost. And secondly, adding more data from a time period when you think the process or the underlying economic relationship was different isn't going to improve your estimate of that relationship over a separate period. Okay, the last thing we want to look at is some types of bias here. And we've got, what, 1, 2, 3, 4, 5 of these to look at. First one, data mining bias, from repeatedly doing tests on the same data sample. Say I had a data sample of firm returns, and I'm trying to come up with some method of putting together portfolios that's going to beat the market. Well, every time I do a test, I'm either going to reject the idea that this method of selecting portfolio stocks beats the market, or I'm going to not reject it. Well, the way statistical tests are set up, I'm going to reject it if the portfolio returns are far enough above average portfolio returns, far enough above the mean. And if I'm doing it with a 5% tail, so I've got 95% confidence on my test, well, there's at least a 5% chance that just because of chance, just because of random outcomes in selecting these portfolios, I get one that had high returns over that period, high enough to reject. Well, I better get back to data mining here. So if I come up with 100 different ways of selecting portfolios, maybe 5% of the time, some of those just by chance are going to look like they worked. So what data mining bias says, well, and it doesn't have to be a single researcher. If I've got 1,000 or we've got 10,000 researchers out there trying different portfolio construction metrics and testing them on the same data to see if they had beat the market, high positive abnormal returns over the period, well, 5% of the time we're going to find something just by chance. And that's your data mining bias. And how do you protect against this? Well, you look at that portfolio construction method for one time period, but you reserve some out-of-sample data. And then when you find out, oh yeah, that worked during that time period, okay, now let's see if it worked in the 5 years after that. And that might be a way to keep from getting in trouble from data mining bias. Sample selection bias. Well, if your sample isn't really random, your results can be biased. I'll give you an example. When the polling agency Gallup, who was one of the real early ones, and at least this is my understanding of the story, they were doing some surveys, and what they told their employees was, look, we want to talk to one house on every block. That was going to be their sample. You need, because everybody's never going to be home, but let's just talk to one house on every block. Well, if you think about it, if you're out on your feet doing surveys, what's the easiest way to do that? Well, it would be to go to the corner where two streets cross and talk to those 4 people that live on the corner. And then you could move down and talk to the next 4, and that way you'd get somebody on each block. Well, it turns out that corner homes are larger. They got bigger street footage. The people who live there tend to have higher incomes. And so they didn't realize it initially, but they weren't getting a random sample. They were getting a biased sample. There was sample selection bias because they were talking to people that lived in corner houses. Survivorship bias, that comes up a lot in mutual fund studies and hedge fund studies because they look at the sample of, say, mutual funds that are out there and say, well, I need at least 10 years of data in order to have enough accuracy, have enough data to test my theories. So they say, well, of all the mutual funds that are out there, which ones have been around for at least 10 years? Those are the ones I need. And so you take those. But it turns out right then you've got a biased sample. Because mutual funds that have poor returns, don't do too well, tend to disappear. They get wrapped into other funds, or they just disappear, they go out of business, or whatever. So when you took your sample of mutual funds that have been around for 10 years, you got a sample of mutual funds that had done better than average. And so that's survivorship bias. What's the remedy there? Go back 10 years ago and take all the funds that existed at that time and follow them forward in terms of their returns. Now, you're going to have to do something when they disappear or get wrapped into another firm, but at least you wouldn't have lost all that data. What's look-ahead bias? Look-ahead bias is when I'm doing my statistical tests using information that wasn't really available yet at the time. For example, if I'm looking every January 1 and I say, yeah, here's my test. Every January 1, I want to pick firms, and I want to take the 10% of the firms with the highest book value to market value ratio, or the lowest price to book value ratio, whichever way you put it. But firms that had low trading values compared to their book values, their accounting values, book value of equity. And I find out, gosh, if on January 2nd, when markets open after the new year, if I had bought those 10% of stocks that had low book to market, low price to book ratios, my portfolios would have done really, really well. I would have had positive abnormal returns. I would have beat the market. Well, the problem with that is that the book value that you're using isn't available on January 2nd. It's only available when the firm finishes its year-end financials, which are going to come out in March or April. So in order to replicate that and actually make money in the market, you'd find out, hey, in order to construct those portfolios, I'd have to use information that wasn't available on January 2nd. So that's an example of look-ahead bias. And time period bias, we've kind of touched on that earlier. You can find a relationship that exists for some time period, but it may not exist during other time periods. There may be time periods where small stocks have outperformed large stocks. And you say, wow, I found out small stocks outperform large stocks on a risk-adjusted basis. We should all buy small stocks. Well, then you find out during the next 5 years, large stocks outperformed small stocks, and there you go. You're suffering from time period bias in your results. Well, that's it for this reading. I hope that helped a little, and I'll see you in the next one. Happy studying.